All right, hey everybody. Wanted to push out a market forecast for the coming year. These presentations tend to start, with and build towards a conclusion. We're actually going to go in the opposite direction, so that we can kind of give you guys an idea of what we're expecting to happen, and then kind of build the case for each one of these conclusions as we kind of go through. So it'll give you an idea of kind of where we're headed with this. But I think it's in this case, it's appropriate to start at the end and kind of work our way backwards. So, the good news is that 2022 really doesn't look like it's going to be the year that the run ends, right? This real estate run that we're on with prices accelerating and so on and so forth. There's nothing that indicates that this is going to end this year. Why? I think basically the reason is there's anywhere from 20 to 25% more people who want to purchase the houses than there are houses to go around. And that's also kind of holding constant the number of listings, at least from a resale perspective, that come on the market this year as opposed to last year. Prices in our region should rise, possibly even spike again. I think there's a lot more evidence or reasons why prices should accelerate again, 13, 15, 18% kind of thing over just a moderate 3 to 5% increase. Matter of fact, we as we were doing this, got an article from the Goldman Sachs research team that I think is kind of the gold standard of research as it relates to most of the economic topics here in the United States and in the world. And their conclusion was roughly the same thing. They're expecting about a 16% increase nationwide in housing. And I think the key quote is simply put that the investment bank feels that the housing market frenzy set off during the pandemic has a lot more room to run. One of the reasons specifically for Richmond is that our migration right now is up tremendously from where it normally is. Our city tends, and by city, I mean the Richmond metropolitan area, so Chesterfield, Hanover, Henrico, city of, and surrounding counties, tends to grow, anywhere in the low 2s, 2.1, 2.3 kind of percent per year. And there was actually a study that came out showing that Richmond had grown closer to a little over 6%, which was one of the top 3 or 4 fastest growing metros in the region. So not only do we not have the kind of the for sale housing inventory to go around to satisfy the demand, we're also very, very tight on the apartment side too, which is another very interesting kind of fact and kind of points to this growth rate that Richmond is experiencing right now in the wake of the pandemic. So not only are there more people moving to Richmond, it's also, kind of globally there, well, not globally, but in the United States, there's a tremendous amount of, this millennial generation, this kind of, 24 to 35-year-old group that's moving through the system right now. And it's just right now getting to the age where it's trying to enter the housing market. And so this millennial gen should provide us with another plus or minus 5 years of excess purchasers as they transition from, their younger years and, college and graduation and first apartment into more of an adult consumer and homeowner. The other problem that we're having is the construction industry just simply can't keep pace. And it definitely, because of a tremendous amount of headwinds from supply chain to prices of materials and so on and so forth, cannot even come close to providing any type of housing at this kind of entry level or affordable options for the folks to buy. And so, combining that with the fact that not only is lot inventory plummeted, I think it's down 20 to 30% in our region, lot development is also slowed as, regions don't have the ability to grow as fast as the population is wanting it to. And that should keep us in this inventory crisis we're in for a prolonged period of time. Another interesting fact to take into account is, as Richmonders, we kind of see our prices going up and think, wow, things are expensive. But people that come to this region from other regions, which is happening at an increasing rate, they look at Richmond as a relative value, and the impact it's having on they're willing to make offers on homes at prices above where Richmonders might is it's a little unnerving and jarring to those who have been watching our market accelerate and thinking, when's it going to stop? For the most part, we are still an incredible value relative to most of the surrounding areas, especially as you move up 95. From a mortgage perspective, this is going to be the year that rates start to rise for sure. I think a lot of people have been predicting this for a while, but the Federal Reserve is now sort of taking its hands off of the wheel and allowing the market to set the rates, which should cause mortgage rates to rise. As a matter of fact, first week of January, we're already beginning to see that happen. That said, it'll still be near historic lows, but they will be higher than they've been probably in the past 18 to 24 months. And I think finally, the biggest point is just there's nothing on the horizon that suggests that these conditions are likely to change substantially from where we are right now. And so I think we're going to be in this crisis mode from an inventory perspective for quite some time. So opening up, I thought it would be important. We saw this quote the other day, and it kind of resonated in that, Elon Musk was talking about how it's important to reason from first principles, which is kind of the fundamental facts, right? Rather than by analogy and saying, well, this looks like this, and I remember this happening, therefore, this 2021, 22 period is a result of these things, because that's how it was in the past. In reality, you need to look down. You need to go down and get down to the fundamentals, right? The bottom line, and kind of reason up. And I think that's what we're trying to do with this presentation, to help everyone understand why we're in the market that we're in. So today's presentation is about many things, but foremost, it's really focusing on the fundamentals. I think as we're entering into the year, you're going to hear a lot of people, talking heads, doomsayers, predictions, and things of that nature. And in reality, they're kind of preying on, the fears of the market. And there are articles about, oh, here comes the crash and things like that. They're really not, the penalty for being wrong about that is very, very low. And so, they're really just trying to gain viewership for their, for their articles and content and things like that. At the end of the day, guys, we've got to focus on facts, kind of the first principles that we referenced a minute ago, to really understand where the market is and what it's likely to do. Okay, first and foremost, I think the most important thing to focus on is this idea of the population and what's going on in Richmond. It's the number one driver of demand. Excuse me. Population trends, so both migration, meaning people moving to Richmond, and then the demographics, the makeup of the people that are moving to Richmond, as well as are already here, are moving heavily in our favor, okay? Meaning that there's a growing population, and it's also a growing wanting to enter the market type of population, as opposed to exiting the market. And this is causing this corresponding hyperabsorption of our available inventory. There was an article written, or a study done by LinkedIn, where they looked at how people are saying, hey, I used to be a freelance computer programmer in Kalamazoo, Michigan, and I'm now a freelance computer programmer in Pittsburgh, right? So they're tracking migration patterns. And Richmond was the third fastest growing region in the United States when they did this study. So this is kind of during the pandemic and what it's causing, since people are now decoupling from geography because their jobs can be done from different locations, so on and so forth. People are now choosing to move from more expensive markets to less expensive markets. Richmond is one of those. And so correspondingly, we've had a 250% growth rate, plus or minus what we normally have. And that's putting a lot of pressure, obviously, on inventory. There was another article that someone sent me very recently, kind of mid-December, where Redfin had done a study and looked at where the most competitive markets were in terms of number of offers relative to the houses that were on the market. And Richmond actually had the highest percentage in the nation in November. And so, that's another thing that's leading us to this idea that what's happening in Richmond has a tremendous amount to do with the fact that there are more people here seeking housing than there have ever been before in our past. At One South, we actually have an internal bidding war tracker where we look at kind of the same things. It can be found on our trends page. So if you go to our website, that's the URL where you can find it. And what we look at is the number of homes that are sold at asking price, above, and below. And then we also look at how far above and below people are bidding on housing, to give a lot of insight to strategies around, if you're in a certain area, if you're in a certain price point, how competitive is that likely to be? So as an example, in looking back from the beginning of the year, between anywhere from 0 to 1.1 mil, almost 55% of the houses, so well over half of the homes that were sold for more than the asking price. So that kind of backs that same narrative that Redfin had seen in their article. I don't know if we were as high as 80%, but maybe during that period of time, that could have been true. So this is a great tool for the public to use, as well as our agents, if you want to get a sense of how competitive your market segment might be. To give you an idea, from a pricing perspective specifically, we entered the pandemic probably, just a skosh shy of maybe $300,000 for our median home price. And by the end of, this presentation, we've already exceeded $350,000. So, $50,000 increase in a very short amount of time has really, again, kind of decimated our affordable inventory, right? So this is what's happened in terms of the number of homes for sale below $350,000. So as you can tell, where that sharp decline in the line occurs is, more or less when COVID began this massive migration and transition from, the old way, so to speak, of the world to the new way in this COVID environment. And so it's really kind of decimated our affordable inventory. So switching gears real quickly, found this chart the other day and I thought it was pretty fascinating. This is actually not for sale housing. This is what's happening to rents right now in our region. So literally since, again, the beginning of Corona and people moving to Richmond, it has shot rents through the roof. So I think I saw nationwide a study that showed about 17% increase in rental. This one shows about 13, but I don't know if they're measuring the exact same time periods or what have you. But in most cases where people are saying, well, I want to, rent and save a little bit of money to maybe get towards a down payment, obviously this is having an impact on that as well. So savings, in a rental situation are not exactly what they used to be. And thus, again, backing this narrative that the population in Richmond has expanded well beyond what anyone had kind of anticipated happening. This is, again, when rents tend to spike, well, why? Because demand is exceeding supply. And that's what we're also seeing. So rental vacancy right now is at an all-time low nationwide. I think it's, hasn't been lower than in the past 40 years. And that's a tremendously long run. So despite the fact that actually that we have built more multifamily properties than at any point in our history, we are still at an all-time low. And that's just, again, kind of this idea of the millennial generation, more than likely is what's the driver of the large majority of this. As they enter the market, seek housing, seeking to form their own household, so on and so forth. Again, it's putting pressure on both the residential for sale housing as well as for rent. So yeah, the for sale and the for rent market are both at all-time lows in terms of availability, backing this narrative that Richmond is in the midst of a population surge like we've never seen before. So that's kind of the idea of how the migration patterns are affecting Richmond. Now look at for a second at, okay, within the people that are here, what does Richmond look like? So I don't know if most folks kind of understand this idea of how this population pyramid, which we're going to talk about in a second, but if you had to guess, I'll share the data with you. The median age in the United States is 38 years old. The median age of the first-time home buyer is 36, so just shy of the median age. And the median age in Richmond is 34, which actually means our population is skewing several years younger than the rest of the United States and hasn't even reached their prime home buying years. So this is what is called a population pyramid, and it groups ages by every 2 years. And as you can see, the number of millennials, again, which is in that age group of anywhere from probably 26 to 36, so 25, that 10-year band. This is what's coming down the pike right now. And as you can see, it is actually in front of so again, we skew a little bit younger, and it's in front of their prime purchasing years, right? So if the prime time to buy a home is 36 years old and the majority of the millennials have not reached that age group yet, they're just on the leading edge of trying to enter the system. Again, Richmond skewing even younger than that. And so what that really has done is it's created this kind of logjam at the point of entry. The stock of affordable housing in Richmond is, it's basically fixed, right? We can't build any more cheaper housing. Construction costs have gone too high. And pushed the ability to build a house well above that $300,000 to $350,000 range, and that's doubly true in the region's mature areas, right, where you've got not large tracts of land where someone can buy 1,000 acres and put in a new community like you can in Western Chesterfield or Southern Chesterfield or areas kind of east of town. And so again, we're in a housing crisis. We were in it heading into Corona, and this is even before the majority of the millennials have entered the purchase market. A quick aside, we're big on data visualization at One South, and one of the tools we're working on right now is a metric that will try to track this idea of excess demand. Again, our early estimates indicate that there's probably anywhere from 15 to maybe 25% more purchasers than there are homes to satisfy this demand. And this is kind of what it looks like. What we did is we went back in and we made some assumptions about when home prices exceed the asking price by a certain percentage. So, if a home sold at the asking price, well, odds are there was, only one, maybe two contracts to drive that result. When a home sells below the asking price, obviously there was more than likely only one offer at that point in time. But when you start seeing home prices exceed 5 and 10 and even 15% above the asking price, well, that generally would lead you to believe that, multiple 5, 10, 15, even 20 offers. We've had several cases of 17 to 25 offers on homes that we've been involved in, especially last year. And so when you begin to kind of total those up and look at it, you can really see the impact of what's happening out there. So this, we're lucky in that we have access to information going back to well before the 2008 bubble. So in this, run up to the bubble in 2008, you could see that demand definitely exceeded supply, right? And thus prices tended to rise. As that fell down, as credit was, contracted, and loans that normally were available were taken away, and we entered into that period, in that 2008, where the market just essentially crashed, you saw a very, very sharp decrease in demand. Well, that's what ended up happening. And once it fell below the number of offers fell below the number of available homes, prices fell. Once it began to kind of enter that early stage of recovery, prices tended to move kind of flat. So in that, coming out 2012, 2013, 2014, we kind of had the same number of buyers as we had sellers, and prices didn't move very much, but at least they stopped falling. And then as we began to recover and the leading edge of the millennials started to enter, again, we saw this price recovery. And then obviously March of 2020 is where this great migration began. And correspondingly, we have had an unbelievable uptick in pricing, largely due to the fact that the number of offers being written on the available housing was way out of skew. So this shows the ratio of offers relative to the number of houses that were for sale. And by tracking this number, you can get a sense of how far undersupplied we are, or how far the excess demand is relative to our available inventory. Keeping an eye on this, I think, is one of the primary sort of canary in the coal mines kind of analysis that you can do to make sure that, when things start to change, we're aware of that. So the bottom line is that, the demand is way up, right? It's the triple whammy for Richmond. We've got record population growth, a younger population just entering their buying years. And again, this idea of, hey, I'll just rent an apartment for, $800, that doesn't exist anymore. So rental market is not a great option either, especially if you're trying to save your down payment. So again, we were already busting at the seams. COVID hit, and the millennials haven't really started entering the market. They're really on the leading edge. So there's going to be tremendous demand for the foreseeable future. So I thought this was also kind of interesting. Richmond, as Richmonders, we've seen our prices escalate, and we're sort of used to the value of a 4-bedroom home or a 5-bedroom home or a condo or what have you, based on traditionally where our pricing has been. But when you look at Richmond relative to other markets, especially those kind of up and down, 95 corridor, our pricing is still incredibly low. I thought this was interesting. So if you look into, this was pulled directly from Zillow. So Washington, D.C. Metro, I think is close to $700,000 in terms of its median sales price. If you go west towards Leesburg and some of the areas at 66, again, that's $700,000 median sales price. Looking at Arlington, so just on the the Virginia side of DC, almost $800,000. This was in Alexandria, I believe. I think this was Woodbridge. Stafford is almost $500,000. Even Fredericksburg is closer to 400 than it is anything else. Charlottesville is 408,000, and Richmond is sitting here at $350,000. So again, while we see our median price having gone from 3 to 350, other markets have seen even more appreciation and look at Richmond as a relative value. And so what's happened, it's created this sort of new mindset where people are not necessarily looking at, a quote, a comp, right? A comparable sale, how we used to base our pricing, where they might look at, a home 2 cul-de-sacs away or a block away or what have you. And, they're looking at, comparing the Museum District to the Fan District or Wellesley to Wyndham or what have you. In reality, the people that are coming here from other regions don't look at it that way. They look at it compared to their own region. It just seems like a relative value. So more so than ever, especially for the population that has recently arrived in Richmond, they are comping their home regions and not individual homes. And this is especially evident for the folks who are, not from Richmond, use this technique, while the people from Richmond are still trying to, to kind of use the old school way of valuation. And it's caused a lot of, I'll just say, consternation amongst the Richmond population when they're constantly getting outbid. So again, it's this idea that buyers not from Richmond feel that Richmond is inexpensive, and the buyers from Richmond feel that it is expensive, and it's caused, again, a lot of problems. So, the idea of what is a home worth, I think and ultimately what it boils down to, it's not what, the appraiser says. It's really what someone's willing to pay for it. And so the growth that Richmond is experiencing is not coming necessarily from within like it normally has. It's really a result of this migration. And people are migrating here from lower cost market, or they're not coming from lower cost markets. They're coming from higher cost markets. So again, driving this narrative that Richmond is a relative value. Okay. Those not from Richmond see Richmond through the lens of where they came from, and they're making housing decisions differently than kind of the local population. I think another thing to bear in mind is, AVMs, which is, it stands for automated valuation modeling or something along those lines. Like basically those estimates of the world or these other algorithms that drive pricing. And, we're using comparable sales or even appraisals. All these valuation techniques lag current market conditions. Well, why? Because they're looking backwards, okay? Using past sales to establish value in a rapidly moving market is dangerous. It's like driving, a car while looking in your rearview mirror. It kind of tells you where you were, but it doesn't really tell you where you're going. And again, we've been trained for years and years and years to look at, comps as the methodology for deriving value, when in reality, that's just not as applicable as it used to be. I think it's a flaw in a lot of our, whether it's the appraisal process or the mortgage process in general. But it's causing, again, a lot of problems, a lot of disconnect from where the market actually is. All right, so that's, again, kind of looking on the more on the buy side. Now let's look a little bit on the sale side. So one of the reasons that we look at resales versus, more new homes is MLS does a good job of tracking the resale market. It doesn't do as good job of tracking the new market. And so we tend to focus a little more on resales to figure out where we are. But I think it's important to note, we hear about an inventory crisis implying that, there's no homes for sale. And that's not necessarily the case. The number of homes that have been brought to the market in Richmond in the past several years, and we'll look at a chart on this in a second, has remained fairly constant. This has really been about a huge and kind of unexpected growth on the demand side. Okay. So again, this idea of, we're in an inventory crisis makes it sound if there aren't any sellers. That's not true. People are still selling their homes. Okay. So if you look at the growth in sales, you'll notice that, the bottom line is you can't, unless someone puts a home on the market, it really can't be sold. I get it. There's some off market sales, but it's such a small percentage of the population or of our sales numbers that it doesn't really change the shape of this curve. So as you can see, we are still bringing homes to the market because our sales are going up. However, right, you can see that number is growing. But when I add back in the homes that didn't sell, right, the ones that expired in MLS, or maybe the agent and the client decided that they couldn't get to the price that they needed, and so they just took the home off the market, you can see that's a lot more consistent than, again, what we would be led to believe. So we've been listing in excess of, 25 to, not quite 30,000 homes in our region in any given year. Again, this doesn't include new homes, just resale homes. So this narrative, again, that somehow there isn't anything to purchase, I don't think it's very accurate. Okay. So I think it's an important thing to note that when people talk about, when you see this measurement of months of inventory, really what they're talking about is not an absolute number. They're talking about a ratio. And the way that's computed is inventory is just simply the number of homes sold in the last 30 days over the number of homes currently for sale. So if you either move the denominator or the numerator, you can shift that months of inventory, right? So if you hold homes for sale as kind of a constant, homes sold, if that begins to rise, will drive down this idea of months of inventory. Okay. So again, homes for sale is an absolute number, 25,000, 27,000, whatever it may be. But inventory is measured in terms of months. So we have 1 month or 2 months or 6 months or whatever it may be. And again, it's a ratio. So when people say that inventory is down, they're talking about the ratio being down. They're not necessarily talking about the number of homes that are down. So really what it's saying is homes are selling much more quickly. And that tends to drive this narrative about inventory being low. There's still choice out there. You just have to act quickly and strongly in order to be able to secure that home. Okay. So now let's talk for a second about the new home supply. That was the resale home supply. This is a chart from the Federal Reserve economic data that has a tremendous amount of information in it, a lot of really, really good stuff in there. And for the most part, this is home starts in any given year. And as you can tell, it bounces around fairly considerably. But I think more importantly is if you kind of look at the trend line, we need somewhere between, anywhere from probably about 1.5 million to 1.6 million homes in any given year to be constructed in order to keep pace with demand. Okay, naturally growing demand, population increase, homes that are, taken out of the pool of available homes to maybe they burned down or were demolished to build something else. But we need about 1.5 million home starts in any given year. Okay. If any of you guys are really interested in following homes, economics, things of that nature, this gentleman, Elliot Eisenberg, who's known as the Bowtie Economist, comes and speaks to the Home Builders Association of Richmond fairly regularly. And as we were putting this presentation together, I actually got an update from him, and he was talking about how the annualized rate of housing is still 1.1 million to maybe 1.2 million. Again, bearing in mind that we need 1.5 million just to sort of break even. And it was the last sentence that kind of caught my eye, which is that, the new homes will not soon meaningfully boost overall supply. In other words, we are not going to be able to get ourselves out of this inventory position that we're in by simply building new homes. There's too many headwinds to do that. So how bad is it? Essentially, a new home is required when a new household is formed. Okay, someone, if there's 4 people that rent a home and one moves out to, be alone, well, they need a new home. And whether that's in a dwelling unit, could be a rental unit, could be a for sale home, but they need a new dwelling unit. Okay, or maybe a child leaves home or what have you. So for the past decade, we have not been producing enough houses to keep pace with demand. This shows the deficit. So this is that red line that you see is tracking. So this line right here is tracking household formation. And so when you take the housing starts and subtract household formation, this is the cumulative deficit we're in, which is about 5 million homes nationwide. That's a big deal, right? That's one of the things that means, we're not in an overproduction mode like we were in 2008. We have been in an underproduction mode for a prolonged period of time, and it was only a matter of time until it manifested itself with what's happening today with prices increasing. So, kind of rarely in history does the construction industry produce more than that 1.5 million houses in any given year. Again, which is the number we need in order to sort of break even. So even if we were able to get that production level of housing up to about 2 million homes in any given year, which would be 500,000 extra homes, it would take, and by the way, we've only gotten there like 3 times in history, it would take us 10 years to erase the housing deficit. So again, this idea that we are kind of stuck where we are right now because we can't build our way out of this problem, and we've got a population that's growing into its home buying years, we got a problem. So, you ask, well, why can't we build more? This was a study done by the Home Builders Association. It looked at how much time, effort, and energy was dedicated to this idea of regulation, compliance with all of the different organizations and entities that control housing, from federal government all the way down to, your local HOA in your community, about, the materials that are required and mandates on efficiencies for HVAC and building materials and code and all of these things, and how does that factor in? And we are approaching $100,000 per new home in just simply compliance with the regulatory environment. And who pays for that? The end user, obviously. And so that's one of the things that's really driven the cost of a new home well above where, the affordability, wants it to be. Okay. So that was a total of, again, kind of $93,000. This was done in May of 2021. So it's a pretty recent article. My sense is it's actually gotten worse. But at least documented last year, it was close to 100 grand. This was a screenshot that we grabbed from, I think, a port in Oakland, and you can see they're talking about how the ports are full and transportation is kind of flummoxed with COVID and so on and so forth, and there's ships just sitting off the coast waiting to get unloaded, and it's really caused a backup for all things having to do with not just construction, but kind of all over the place. All the shelves are, beginning to get a little more barren and so on and so forth. And, there's a lot of delays. This was another stat that I saw showing where, household appliances, right? So your washing machines and your microwaves and probably even your HVAC equipment, that's on a huge backlog as well. That's doubled since really the beginning of COVID. And that's having a huge impact on just the ability for home builders to get their homes finished, as well as pricing, obviously, too. So this is, again, going back to the the Federal Reserve Economic Data website and looking at the cost of construction materials, right? You can see Once COVID hit, which is the thin gray line there at the end of 2020 or beginning of 2020, right? That's what's happened. It's a huge spike in costs for builders right now. Trade wars, supply chain issues, just general inflation. And obviously it's not helpful to the affordability problem. And thus, again, we're stuck not being able to build our way out. And even if we could, we still can't build at any remotely affordable level. So what's the result? Obviously 100 grand in compliance, per home. That's 25 to 30%, probably, if not more. Again, material prices all-time high, supply chain issues, and also just an inability to develop land. This is an article from CNBC that we found, from, again, kind of back in the real throes of the COVID migration. $36,000 extra in lumber. That's actually gone up. And it's also important to note that lot supply is down 20%. That's huge too, right? Because even if we could build houses, we still have to have lots to build them on, and that supply is dwindling. So again, fix all the supply chain issues, but if there's no lots left, again, very, very difficult to fix this inventory problem. So here's to kind of give you some numbers. Here's an impact on inventory. I looked at kind of 3 different price points, and this is coming directly from our MLS. So $300,000 or less. So really the truest affordable segment. From $300,000 to about $600,000 and $600,000 or more. And ultimately what you see, excuse me, is less than a month's inventory. Again, this is resale homes. So less than a month's inventory, all the way up to $600,000. At $600,000, it's getting a little bit up there in terms of price. And so, you may see, a few more listings in that space. But when we add in new housing, you're talking about 0.3 months. That's a week and a half of inventory. We go from 0.8 months to 1.1 months between $300,000 and $600,000. Above that, a whopping 0.6 months. What's that? 3 weeks plus or minus. And below $300,000, adding in new homes doesn't change the inventory at all. So again, kind of hitting on the same point in a lot of different ways. But I think it should drive home this idea that inventory is very, very problematic. Okay. So again, when you look at here's what's coming and our inability to build the houses to house these folks, this is why we're saying we are, in a prolonged period of, struggling with supplying the demand that's coming. Some other issues that are a little bit unique to this market and kind of lend credence to this idea that, a lot of people are seeing housing as a really good hedge against inflation and what have you, is as opposed to just individual homeowners purchasing homes, they're now in competition with pension funds, with investment funds. This is on an article written that just came out, as I think it was actually today I saw it, where Zillow, that had begun to buy in homes themselves, are now selling them to a lot of the folks on kind of the funds on Wall Street. This is an example. I think it was 7 out of every 10 homes in one zip code in Atlanta had been sold to investors, right? So no longer are just, by the way, when these houses go to these investors, the likelihood of them coming back out later as either improved or just, kind of in the normal resale, they're going to be held out of the market for quite some period of time. Investors tend to hang on to properties for a long time. So it's also going to continue to drive down, availability. Luckily, this hasn't really hit Richmond necessarily yet, or even DC, but there's a lot of other markets, Phoenix, Atlanta, Charlotte. I think I saw references to Jacksonville, some places that are, not too dissimilar. And again, more southern markets than northern markets. Those homes are getting gobbled up by funds, taking them out of the ability, or taking them away from the people who really do need to try to find affordable housing. And that's a problem. Again, it hasn't hit Richmond, but that just means it hasn't hit Richmond yet. It's coming fairly soon, as Richmond tends to skew maybe a couple of years behind some national trends. Interesting, BlackRock is one of the largest investment funds, I think, in the world. And when I actually Googled BlackRock and I think real estate, this page showed up. And actually, you could download the report on why they're buying real estate. It's kind of interesting to read. They believe, that it's a very, very protected asset, meaning that there's not enough of it to go around. And it's a great inflation hedge, and we're going to talk about that here in a second as well. So if you're a buyer, especially this millennial gen, these are your headwinds right now. You've got competition with very, very well-funded investors, already low inventory. Your rents are rising, cost of new construction is rising, and your mortgage rates are about to start rising too. We're going to talk about that in a second. So summary for on the supply side is, we can't build homes fast enough. We can't build them cheap enough. There's more competition from, again, this idea of investors and investment funds. We're 5 million homes undersupplied with material costs skyrocketing and lot inventory plummeting. And ultimately, it just means that the supply of housing in the United States is not growing fast enough to satisfy this demand. Now, in a lot of cases, kind of heading back, to 2008 and then what's happening right now, I'm going to apologize. I get it. Talking about inflation is a little bit boring, but I don't think that you can have a sense of what's happening in 2022 without having some kind of understanding about inflation and why it's so severe right now. I'll try to keep this short. But this idea of inflation, right? Inflation is this kind of this concept where goods and services tend to increase in price over time, which in turn kind of decreases the value, of the dollar, right? It decreases your buying power as an individual. As prices go up, the value of the dollar tends to go down, right? So we've all seen these examples of, back in the day, right? Your grandparents or whatever talking about, I remember when I bought my first car, or, some of the houses, the Sears and Roebuck houses, you see advertised 4-bedroom and a bath was the name of the home, and it could be purchased for $3,000 or $5,000 or $10,000. I just think that's kind of mind-boggling. And I found this too. Imagine getting, a large pizza for $1.50, right? Like that gives you a sense of how much over time our dollars have been degraded. So, but the interesting thing is, inflation really hasn't been an issue for quite a while. The Federal Reserve and monetary policy and things like that have done a pretty good job of managing inflation to such a rate that it hasn't sent severe supply shocks or price shocks through our economy. Okay, so only one time in the past, since 2000, did inflation creep above 5% a year, and that was right before the bubble, and everyone was making so much money, no one cared. But if you have to go back to literally people who were 70 years old today, we're kind of just entering the working market back the last time that inflation was an issue, which was around 1980. Okay, so if you're 55, I happen to be 53 years old. I have a vague memory of the news talking about inflation, at night, and seeing, my parents complain about prices of stuff was getting really expensive, and there was, rationing for gasoline, and it was just kind of a really screwy time in that late 70s, early 80s. But the majority of the people out there right now, again, median age is 38, really weren't even on the planet at the time, last time that inflation was an issue. And I think that's hugely important, because if you have experience with inflation, you'll be able to discern the difference between inflation and this idea of a bubble. Everything right now looks like it's a bubble, right? So we'll get to that in just a second. This is the Consumer Price Index, which kind of measures the common goods and services that we all use. This doesn't include energy and food, because those tend to have a little more, price escalation in them based on, micro supply and micro demand at the time. So, call it your cleaning bill, or your I don't know, computers and things like that, right? You can see that over time, it's been pretty slow and steady. There haven't been times when, and this is smoothed out because I used a year for each data point, and you'd see a lot more noise if I measured this monthly. But it's been pretty consistently kind of, you don't even notice it almost. So prices are up a little bit, but you don't really feel it because they haven't spiked. Now, that being said, when you kind of look at this, just past when we had the recession, a brief recession, when Corona hit, we all went on lockdown, you're seeing a lot more kind of wonkiness up there. And that's what's happening right now. So to kind of reiterate, inflation isn't a bad thing either, by the way. It sounds a little counterintuitive when you think, oh, I don't want my prices to go up every year. And the answer is kind of, yes, you do. Why are rising prices good? Because falling prices are bad, right? If you think about it, if you were a home builder, would you build a home if you knew that, it was going to cost you $400,000 to build it, and, but it was only going to be worth $350,000 later? Of course you wouldn't. Computer manufacturers, or, any producer of products or services, if they think that prices are going to go down, well, they won't, create that product. And same thing if you were a consumer, if you thought, hey, if I wait, the price of this good or service goes down, where you're going to wait. So we want the expectation that prices are going to be more in the future, because it incentivizes us to act today. Okay, so deflation, prices going down, all these other, We don't want that. That's bad. That's really bad. And that's really what happened in 2008 and what caused a lot of the foreclosures. Okay. So low levels of inflation are good. They set an expectation for goods and services being worth more in the future. But rampant inflation, like we're beginning to experience right now, that's also not good. Rapid price increases kind of send shocks through our financial lives, and it sharply decreases the value of our currency. Okay. So high inflation is especially damaging for those who rely on fixed income or defined benefit plans, right? Because if you're getting $5,000 a month out of your plan and all of a sudden prices start to escalate quickly, your buying power goes down. And if you're retired or what have you, you can't just go back to work, get your old job back, and start earning that income to make up the difference, right? So it's very, very damaging to the people who are on, again, this fixed income or kind of defined benefit plans. Bad. It's also bad when you're trying to forward lock. If I'm a contractor and I'm trying to, I commit to a price today, but I might not deliver this product for a year, like homes. You're locked into a price with a consumer, and next thing you know, your lumber is up and your labor is up and all these kind of things. So rampant inflation is it's not cool. It also hits the benefit plans and things like that, Social Security, because now all of a sudden they've got to promise more money to make up for the loss of buying power, which in turn shrinks that fund. So again, rampant inflation sends a lot of shocks through our financial lives, and we need to be careful because right now it's starting to get pretty ugly. So what causes rampant inflation? Well, obviously, when Corona hit, the government pumped something like $2.3 trillion into our economy in order to make sure that we didn't have the opposite happening, right? This idea of deflation and prices going down like we had in 2008. Okay, so when it hit, the government was kind of faced with two alternatives. We could pump money into the economy and sort of deal with the consequences later, not, and they did it, they did it not really knowing what the outcome was going to be. Or they could have done nothing and just sort of hoped that the economy was strong enough to handle that shock. And, in my opinion, and I think in a lot of others, it was the right decision to pump money into the economy. The question is whether or not they got that amount right. But ultimately, what they did when they pushed this money out, strings attached, businesses had to keep people on payroll. Businesses ended up staying open to make sure that they would be able to, receive that money and then write off that debt. There's a whole reason around how they created this new liquidity in the market. The other thing that it did, and you can see it in the housing market now, is it pushed asset values higher, right? The alternative, again, we talked about this idea of deflation where prices go down and unemployment goes up. It really creates this vicious sort of downward spiral, right? You get a foreclosure. Well, the foreclosure tends to have a negative impact on prices, which then creates more foreclosures. And we end in this kind of this spiral out of control. And nobody wanted that. That's really bad. Again, that's 2008. So to give you a sense of what happened, I plotted $1 billion, $100 billion, and $1 trillion. I couldn't even get $1 billion to show up on a graph when I graphed it next to $1 trillion. So we put $2.3 trillion into our economy. That's a tremendous amount of money. Graphically speaking, this is what it looked like. If you couldn't tell, that's when COVID hit. And it's kind of funny, when you look at these things and look at charts and graphs and stuff like that, you never see a chart that looks anything like this. And that was the amount of currency that they put into it. This is the overall impact that it had on the money in circulation. So savings and investments and so on and so forth. But the bottom line is 40% of the money in circulation has come in the wake of COVID. And so, that's having a huge impact. Now, again, to the Federal Reserve, Congress, whatever, their credit, if you go back through history, you look at what happened in the Great Depression in 1929. It was thought that in order to protect the banks, they needed to shrink credit, right? They needed to say, no, you can't give the money out and so on and so forth. And what it ended up happening was it caused a run on banks, and the banking system absolutely crashed in 1929. And so they didn't figure out that, hey, we went the wrong direction with this. We should flood the money with credit, or flood the market with credit, flood it with money to encourage people to invest, get people back to work, and so on and so forth. And so that time period between when the stock market crashed in 29 and they started to, fill the economy back up with liquidity was about 3 years. And that led to a decade-long Great Depression. It could have even lasted longer had World War II not occurred. But you can see that by waiting and having things crash, it took them much longer to fix it. In 2008, as the market, the financial markets were in free fall, there was a lot of arguments within our government about, should we save the bank? Should we not? Should we just let this whole thing crash? And, there was actually several times where, the monetary policy was voted down, i.e. TARP and things like that. It took them a couple times to get it through before they finally did. It took them something like 3 or 4 months to get all this stuff worked out. And the entire time they were arguing about what to do, the banking system was in free fall. And thus our recession in 2008 lasted 3 or 4 years. This time around, again, I think they took their lessons and said, we've got to go into lockdown. We don't really know what's going to happen, but let's go ahead and just inject a tremendous amount of liquidity into our market. And our recession really didn't last very long at all. It was actually more driven by the fact that, we couldn't go to the movies and we couldn't go on vacation and things like that. It really wasn't anywhere near as severe as what happened in the previous 2 times where there was an absolute crash in our economy. And so again, if you put that much money in, you're going to end up with some tail consequences, but it's much better than the converse. I've always found this tweet kind of funny. I saw this the other day, and it was this idea of, anytime there's any kind of event that occurs, we tend to just drop the interest rates, right? So this guy said, when we're, if Martians land on the Earth, their first response would be to lower the interest rates. I kind of find that funny. So again, back to this idea, was 2.3 trillion the right amount of money? I don't know, but I am saying that if you do that, yes, you're going to save a lot of things and keep them in place and keep them operating, but you're also going to have other consequences. COVID forced our leadership to make this decision, and they had to make it, quite frankly, having never experienced anything like this. I personally, like the fact that they did it, because I've lived through 2008 and I don't want to do that any time again, but now we're kind of dealing with the fallout. Anytime you put 40% more liquidity in any market, it's going to have a corresponding impact on prices. And that right now is what we're dealing with, right? We're in this midst of this pricing reset, which we've never seen before. And, it's a little bit unnerving on a lot of levels. So just to summarize, deflation is really, really bad. We don't want that. A little bit of inflation is good. Rampant inflation is also bad, but it's not nearly as bad as deflation. So again, COVID was forced upon us, and we are, it's like, it wasn't our mistake, but it is our problem. And so again, I think the idea that the market is doing what it's doing, it's not great, but it's much better than what could have happened. All right. So that's inflation. That's your short primer on inflation. Now let's talk about the difference between inflation and this idea of a bubble. Okay, a bubble, or more specifically an asset bubble, is this idea of like an industry, housing, or a particular type of investment, stocks, gold, whatever, dramatically increases in price over the short term, but it's not really supported by the value of the product, right? There's some irrational exuberance or something else that's out there that's causing this run up, other than the fundamentals of that industry, product, or asset. So again, prices spike in the short term, but once people kind of lose enthusiasm, there's usually a corresponding collapse soon thereafter. Okay. For those who remember the dot-com bubble back in 2000, pets.com was one of the first internet companies, and they were trying to figure out how to market pet food and toys and other supplies online, and they were terrible at it. They were losing money left and right. But they spent, millions of dollars on Super Bowl commercials and things like that. So that's an example of, kind of this idea of a bubble. GameStop has recently been one that I think is kind of interesting, where, there was the Reddit thread, and, there was this huge run up in GameStop, even though there was nothing supporting it in terms of earnings or other business practices. And then a corresponding crash down afterwards. A lot of people lost a lot of money. And oh, by the way, bubbles go back in history. There's a great business school case, from, I think, Holland back in like the 1600s, somewhere in that range, where this idea of these beautiful tulips became overvalued, and they almost were used as currency in some cases. And again, the value of these tulips got run way up and then subsequently crashed afterwards, because there just wasn't anything really supporting that other than kind of a mania. So when we talk about bubbles, what's the one bubble that we all know, right? It's 2008's housing market. Okay. Now, the problem is that bubbles and sort of this idea of rampant inflation kind of presents in the same fashion, right? Prices escalate. But the difference is, in inflation, prices tend to go up and sort of just stay there, where bubbles, they go up and they fall down. And since everyone's most recent experience with rapid price increases was 2008, The prevailing thought is that, the housing right now is experiencing another bubble. And that's not really the case because the underlying causes are a lot different. So in 2008, I think, one of the things that really drove what happened in 2008 was this idea of banks' willingness to extend credit, okay, to people that should not have deserved to receive that credit. It was very, very risky underwriting, okay? And you can see that in 2008, leading into that, banks were taking on way too much risk to the point where when it collapsed, there was nothing supporting what they had done. Consequently, one of the reasons that 2008 also lasted for quite some time is after the fact, banks were unwilling to extend those same loans. And so we really had to find a natural bottom before we were able to build our way back up and out of this underwriting idea, okay? And so again, 2008 was much more about credit. So how does that compare to today? So again, looking at where 2008 occurred, if you look at over here, this idea of blue is where they call it PLS, which is private label. This is your subprime loans. Okay, so this is all the loans where maybe they loaned 125% of value, or they, it didn't matter what your credit score was. They were underwriting. There's a lot of fraud in the market and all this kind of stuff. So this was the dangerous part of the market. This was something approaching 35 to 40% of all loans issued before 2008 were essentially either not underwritten or underwritten so poorly as it almost didn't matter. All right. The gray here, this is your Fannie Mae and your Freddie Mac. So in other words, this is where you have to go through your standard underwriting. The black here is FHA or VA, again, standard underwriting. The yellow is really, you go down to your local banking, contact, and you say, hey, I need to borrow money to buy this home or what have you. And so they underwrite you, but then they also keep that loan on their books. So their incentive to underwrite you correctly is also very, very high. So if you look at the difference, again, 35, 40% of the market pre-bubble was underwritten incredibly poorly. That's only 1% of the market right now. So this idea is that, that housing is in another bubble, really, it doesn't look at what caused 2008. It's just simply looking at pricing and thinking because pricing went up, it must come down. Secondarily, I think is also very important. Again, 2008 here and kind of the time of the crash. This gray here is your 30-year fixed mortgage, right? So your payment doesn't change over the course of the life of that mortgage. Black, again, 15-year, but fixed, okay? So the idea is that, you're going to build equity even faster because you're going to pay down your mortgage more quickly. But again, the payment doesn't change. Blue here is this idea of the adjustable rates. And many of these adjustable rate mortgages in 2008 were actually designed to adjust on purpose to try to get people to refinance so that they can make more fees. So it really wasn't even sort of this true adjustable, which were used back in the early 2000s and could be used and applied correctly. This was, again, a fraudulent, very, very poorly underwritten loan. And again, making up a third of the market. So, as interest rates changed, people's mortgage payments changed. And in most times they were designed to actually kick up, sometimes as much as 2x, right? So they would give you this teaser rate and allow you to get in for a super duper low payment, knowing that 2 years later they were going to reprice and force you to come back to refinance that loan. And when prices started to fall on housing, well, then people couldn't refinance, and that's what started this foreclosure. So again, this right here, the blue, is sort of the fake bad adjustables. And again, if you look now, we're like 1% of our all loans are adjustable rate right now. It's almost, I'm not saying that anything is risk-free, but it doesn't create nearly the amount of risk that was in the market prior to. So if you look at the housing market and the debt against it, right, the mortgages against it, almost everything, 90+% of these things are fixed rate mortgages. Almost all of them are at 4%, or less. If you didn't catch a refinance bottom, kind of shame on you. So I'm imagining that the majority of this debt is somewhere between 3 and 3.5%. Oh, and by the way, it was underwritten correctly. People with stable jobs and, all those kind of things that were totally ignored back in the day. So the bottom line is the mortgage debt that underpins our market has never been healthier than it is right now. And that's a really, really good thing. It gives all housing a lot of resilience. Okay. And when then you look at pricing, the blue line is basically the debt. The black line is the value of our housing collectively. It's like 36 trillion. And therefore, if you take 36, subtract away the debt, this is the value right now. This is the equity that we have in our housing market. So if you look at what, again, where we were in 2005 leading into the bubble and where we are now, it's, you know, somewhere between 2.5 and 300%, 250 to 300% greater now than in 2005. Meaning that even if there were a shock to the system, the idea of free fall is incredibly low. Well, why? Because there's equity in the market and our payments are fixed at very, very, very low rates. Again, housing market is very, very healthy. So again, to kind of go back and kind of compare and contrast, 2008 was demand falsely inflated by bad underwriting. Okay, originators didn't have the responsibility for the loan's performance, so they would underwrite anybody. Poor credit scores, highly leveraged loans. You know, again, this idea of adjustable rate mortgages with teaser rates that were designed to force people to take action to refinance to generate more fees, which was really, really dangerous. There were even interest-only mortgages out there, or sometimes even negative amortization. You could choose your payment. That's how bad it was towards the end. In 2022, you know, what are we looking at? Well, home deficit of 5 million, millennials entering. I said millennial, got a typo there. Material shortages, skyrocketing prices. Again, funds now entering the market. And $100,000 in compliance costs, meaning it's really, really hard to bring houses to the market. So this is kind of I thought this was an interesting way of looking at it. You know, if this is the point of entry, right, it's really constricted. And these are all the people that are now trying to get through that mark. And that's why we're seeing rapid price increases, because there's this logjam at the point of entry. So to compare 2021, 22, systematic lack of supply, real demographic trends, historically interest rates, you know, that's had an influence on pricing. And, you know, as they rise, that'll kind of tease out. And again, this idea of $2.3 trillion has devalued our currency, and that's escalated assets. 2008, just bad underwriting. And, you know, just a free for all. And I just can't stress that enough, that there's just massive difference between the two. So at the end of the day, you know, if you're a purchaser and you're waiting for this housing market correction, I think, you know, you're going to be left wanting for quite some time. And I think if you wait to enter, you're going to be costing yourselves hundreds of thousands of dollars of sort of housing dollars, if you will, between mortgage payments and down payments and price you pay. As you wait for this idea of a correction to occur, there's just nothing out there that leads us to believe that it is likely to occur. There's nothing that can be seen that leads us to believe that that's about to happen. Okay, so inflation and real estate actually are a lot of, you know, they're very closely tied. I overheard this conversation happening the other day with a couple agents, and one of them, you know, basically just said, I think there's a lot of people out there right now who again are going to play this waiting game, and they're just going to miss out on the opportunity of ever owning a home, because pricing is going to get so far away from them and the rates are going to go up. And, you know, they're just not going to have the wherewithal to purchase. And I think they're by waiting, they are quite frankly damaging themselves, and, you know, maybe even missing out on this opportunity. And that's, you know, it's very unfortunate. Now, you may not even believe us, you know, we're just realtors talking about this, but, you know, someone like Warren Buffett has also said, you know, inflation and housing, real estate is good during inflationary times. And his reasoning is, you know, you buy it once, and yeah, you may have to clean your gutters or, you know, put a roof on or whatever. And there is some cost going forward, but it's not like you're a restaurant, right? Where every day you're having to reprice your materials, you know, your food and all these kind of things on a daily basis. So profit margins tend to get very, very squeezed during inflationary times for businesses that have to, you know, essentially reprice on a daily basis. Once you purchase the real estate, you own it, and the price that you pay for it is going to last you almost forever. Okay, so during times of inflation, real estate is a tremendous hedge against, you know, the value of currency going down, right? Because the value of your asset tends to inflate. Your debt stays the same, but the house value goes up. So again, important to own during these times. Okay, and that kind of holds true for any real asset, right? Whether that, you know, might be gold or, you know, some other stocks and bonds and things like that. Again, values go up, debt stays the same. So during times of inflation, real estate disproportionately benefits. And, you know, anyone who owns a decent amount of it right now, you know, has got a pretty big smile on their face, because they have directly benefited from, you know, the conditions in the market. So if you don't own real estate, right, you're missing out. So going back to this thing earlier, one of the primary ways that the United States and, you know, residents build their wealth is through housing and the equity that they have in it. This was a study done a year or two ago, and it talked about how the average homeowner has a 40 times greater net worth than the average renter. My sense is that number is probably up, simply because rents have increased, which would degrade the net worth of the renter, and housing values have gone up tremendously. So, could that number be 50 times greater right now? Quite easily. I'll be curious to see the next time that measurement comes out where it is. But the bottom line is, ownership of real estate is generally a very, very good decision when it comes to things like net worth and, independence financially. So shifting gears here, we're going to talk real quickly about kind of the mortgage market. Again, going back to this Federal Reserve economic data chart, I think this is kind of interesting to see. Going back into the early 80s, I mean, interest rates were at 18%. I mean, like, that's just so unheard of in today's world. But that's where they were. When I actually got licensed back in the early 90s, closer to 10. I remember 8, 9% being kind of the norm. I thought when we got in the sevens, I'm like, wow, this is going to be great. But it's continued to fall since then. Right now, we've been hovering around this 3%, starting to bounce back off that bottom a little bit. But even going back, to when interest rates were consistently above 5% was over a decade ago. We touched it, I guess, back in probably 2017, 2018. But generally speaking, interest rates have been, below 5% now for well over a decade. So you may be hearing a lot of news about the Federal Reserve right now and what they're doing, and this idea of tapering. Tapering is nothing more than ending this practice of sort of putting their thumb on the scale, right? The Fed can influence mortgage rates by buying or selling the mortgage bonds that are created on the secondary market. And right now, they've been really kind of using their power to keep mortgage rates a little bit lower, again, to keep these asset values up. They're going to stop doing that now. And let the market really set the rates where they want to be. And that's why this is going to be the year where you begin to see mortgage rates rise. Okay. So again, even in January, we're starting to see it happen. Secondarily, they're also going to start raising the short-term rates, which is, kind of this idea of going to, banks can go to the Fed and borrow money in the short term. And so it's a little bit like tapping the brakes on the money supply. This is the effort to get rid of inflation. Okay. So as the 2.3 infusion in the economy, it's kind of rearing its ugly head right now in terms of price increases. They've shoved so much liquidity in the market. They need to kind of start pulling a little bit back out right now. So short-term rates, which are more what drive like credit card rates and things like that, they're going to start escalating a little bit. And they're also going to start allowing, again, the idea of the mortgage rates to start rising a little bit. Again, I don't think it's a huge issue, but it's just something to be aware of. A lot of experts are predicting 30-year rates as high as 4. I think the bond markets are saying maybe not 4, maybe 3.5, somewhere in that range by the end of the year. But make no mistake, the rates are starting, the environment is starting to head up. And the more we hear about inflation, the more that's going to kick it up. So what's the impact? A full rate point right now, when you go from like 3 to 4%, it's about $50 per $1,000 that you borrow. So if you were looking at that, if you went from 3 to 4% on a $300,000 mortgage, you're going from about $1,260 up to $1,400. So a couple $100. That's not a massive shift, but when you also start looking at pricing escalating, it's kind of an exponential thing, right? Where all of a sudden I'm paying more for the mortgage, and I'm also going to end up paying more for the home. So, if you're at kind of your maximum qualification right now, that's where the people are the most sensitive to it. So if you're, a 97% borrower using FHA or, 95 on Fannie, and prices are moving up and your rates are moving up, again, that's going to be problematic. So, the earlier you act this year, I think the better off you're going to be, right? So just, 3% is kind of what we think about. 4% is still a phenomenal mortgage rate, if you kind of look at history, okay? But it still is going to make a difference. Okay. So, that excess demand that's out there, a lot of those are cash buyers that are not nearly as subject to this as others. But if you are one of the people that needs maximum leverage in order to be able to purchase, this is going to hit you kind of hard. So the earlier you get started this year, the better. Okay. And I would also take this, as a little bit of an opportunity. Again, going back, we haven't been above 5% in our mortgage market since 2011. Going back into the 90s and early 2000s, there were a lot of times where if you were only going to own, it was a starter home for you, you plan on living there for 5 to 7 years, you could get a 5-year adjustable, meaning that for the first 5 years of your mortgage, your payment wasn't going to adjust. Beginning in 6 years, it would adjust up and then stay that way for 5 more years. So there's this entire kind of industry based on different lengths of time where mortgages are fixed. that we haven't needed, again, since, probably rates were more in the sevens is where these, kind of when it made sense to maybe look at other options. So I don't think that's coming this year. But, if you're a follower of these things and you want to learn more, I think getting with some mortgage people early who have some experience back kind of pre-bubble and understanding those markets, that's going to be a big deal. Again, I don't think it's coming out today, but I think soon we'll begin to see alternative forms of finance in terms of differing amortization schedules, different fixed loan or mortgage rates for periods of time, 1 year, 3 year, 5 years, 7 years, things like that. They're coming. They're not here yet, but I think they're soon going to be here. And it's, again, kind of an important distinction. So again, back to this idea, if you are a maximum borrower, meaning you're really borrowing the max and putting down the minimum, guys, get started early. Again, we're expecting pricing to run. If you're under contract in January, you're going to get rates in the low threes probably. And, you're also not going to experience that, springtime run up where again, we could go up another 10 or 15% in terms of pricing this year. So acting early this year, I think is critical because as the year evolves, you're going to see again, pricing and rates start to rise and really make housing much more expensive. Number two, if you're going to lease, go back and read your lease, but most of the leases with the large property owners kind of have a clause in it that say you can break your lease for a 2-month penalty, meaning that you're going to have to write a check for 2 months of rent in order to break your lease. It doesn't impact your credit, like not paying your rent, that's bad, that impacts your credit. But if you elect to use one of these clauses in your lease, provided that it's there, it may make some sense. Well, why? If you're on a $1,500 a month lease, that's $3,000. But if it's going to take you $15,000 in a bidding war to win by the time you get to March, April, or May, right? Use the tools that are around you. Is all I'm saying. Like, don't be penny wise and pound foolish. Use the tools that are there so that if you do need to get started earlier, again, to avoid some of the high pressure times during springtime and summertime in order to get into a home, this might be a really good tool for you to use. So go back, read your lease, get with your agent and understand better how to use the opportunities that are around you. Make smart decisions. Number three, again, if you're back in this kind of max leverage space, buying a brick Cape Cod near Willow Lawn may just be impossible for you. There's not enough to go around. There's people chasing it with a lot of equity. And so when you're using max loan subject to appraisal, sellers are just going to say, you know what, I'd rather not take the risk of a loan. I'd rather take a certainty where, someone may be only borrowing 50% or someone may be using all cash or what have you. So look to less competitive areas. We actually have a tool, again, at OneSouthRealty.com on our trends page, where we show you availability, okay, of any segment by $100,000 bands and zones so that you can say, oh, wow, in, zone 36, between $400,000 and $500,000, actually 4 to 6, there's like 70 choices. Okay. The likelihood of you ending up in a bidding war versus trying to go into say, zone 20 around 300 grand, again, there's three available. The likelihood that the demand is much greater than the supply in really restricted zones is greater, meaning more bidding war, more pressure, less likelihood of success. 20 years ago, you didn't have to worry about this as much. Now you do. And so how you choose to enter the market is really important. And you may not be able to go straight to the home that you're looking for. You might have to take an intermediate step and go buy something a little bit further out or, where there's a little more new construction and things like that. But it allows you to build equity, to lock in a good, mortgage rate for your property and to begin to experience the benefit of ownership. Again, this tool is available. I think it's a really easy tool to use given market conditions today. Lastly, building also may be an option. I know that prices are higher, but very rarely is there a bidding war on new construction. And so, maybe it's even a townhome or, one of the 2-over-2 condos that are becoming increasingly popular, somewhere, kind of in this mid-range or, kind of near West End area, in order to get in the game. Okay. So you can purchase locks or you can find maybe one that's halfway through construction and it'll be completed in another 90 days. And so you can still protect your mortgage rate in that regard. So again, I think there's ways of getting in the housing market without having to go through the misery of a bidding war or losing multiple wars and so on and so forth. So again, it's more about strategy of entering the market now than it's ever been. And I think that's hugely important for buyers to understand. So another thing to kind of think about too, again, this is kind of a reset of a mind, kind of a mindset reset, if you will. Fannie Mae was founded in the 1930s. I think FHA was as well. And so, a lot of the historic ways about underwriting, these are decades and beyond older, right? And so the mortgage process wasn't designed with 2021 or 2022 in mind. We didn't even think about COVID and massive migration and the decoupling of, where you lived and where you worked, because you can now remote work almost anywhere. Like, so all these ideas of, how mortgage processes were designed, they don't work anymore. They were designed for another era, right? Where prices went up a couple percentage points a year and buyers put 20% down, and you worked at the same company for 30 years and all these kind of things. That's just not how our market is anymore. And I think again, any government or quasi-government agency is very, very slow to react, right? They don't like to change rules very often. And so, it's making using the typical mortgage purchase products a lot more challenging in the environment that we are in. So again, I think it's almost like you feel like it's your right to be able to purchase this using these tools, when in reality, the tools just aren't very applicable for where we are right now. So you have to begin to think a little more creatively, tap other assets and things of that nature. But again, I think it's something important to kind of consider is how we buy and the market we're in, they're further apart than ever before. And it's causing, again, a lot of consternation in our market. We wrote an article on our blog, matter of fact, if you want to read it, kind of detailing this a little bit more, this idea of how the appraisal process specifically is broken, because it just doesn't know how to handle rapid appreciation. So if there's sort of nothing else to take away from this, this thing today, it's about supply and it's about demand, right? All this other stuff that we kind of see is noise to some extent, because almost everything else, it kind of either falls in one category or the other. All right. So focus always on supply and demand. This is a gentleman, his name is Robert Schiller, and he's created kind of this gold standard of house price appreciation measurements across the United States. And it's called the Case-Shiller, and they got a 20 city and I think a 40 city and then index, where they look at home prices in the largest metropolitan areas. They don't really look at pricing like, oh, it's between 400 and 600 or, whatever. They just kind of look at it in the aggregate. And so it's a measurement of home prices. And if you look at it on this chart, right, this is essentially no inventory, 0 months of inventory. This is 14 months of inventory. Okay. So, and then on this axis is monthly appreciation. So if you go up here to 6 months of inventory and you kind of crawl across, you begin to see that prices don't move very much, maybe 0.5% a year, maybe, almost nothing a year, right? So you can kind of expect that if there's 6 months of inventory, price appreciation is going to be fairly minimal. Okay. Again, kind of in that, a couple percentage points a year. If you look at the kind of the congregation of dots here in this area, this is the reason there's so much concentration of data there, is because that's kind of typically where our markets stand, anywhere from maybe, call it a low of 6 months or a high of, 6 or 7 months down to maybe 3.5 to 4 months of inventory. And thus appreciation rates kind of hover in this general area of 0.5% a month, which is annualized 5 or 6% a year. And so I think this is also important to note that, where do we flip from positive appreciation to depreciation, negative appreciation, right? Where prices of housing start to fall. And that's right around this 7-month mark. Okay. So again, the lower the inventory, the further out on the, kind of this correlate, this regression line, if you will, you go, the more appreciation you can expect. And it's pretty tightly correlated in here. I would imagine that this is a pretty good predictor of appreciation. So again, keeping your eye on inventory means you'll get a sense for how appreciation is going to work. That's nationally. And so, the question is how does that apply to Richmond? And it was relatively easy to go back and double check. And so what we ended up looking at is this idea, of where in, I went back to the pre-bubble again and looked at where did pricing stop falling and start rising again. And if you kind of follow this down to our inventory levels, okay, month supply, you see that again, it flipped from positive to negative at this spot, which is again right at 7 months. So that Case-Shiller index seems to be a pretty good predictor of not just nationally what's going to happen, but also what's going to happen in our market. And so when you look at it, again, kind of going out to where we were this year, most of the year, most markets in America spent somewhere had roughly 2 months of inventory at any given point in time. Well, if you come out here and then go down, you'll see that led to about 1.5 points of appreciation each month. That is 18% annualized. The last stat that I saw was, I think from July to July, we were at 19.7 nationally in terms of appreciation. Okay, so those things sync up fairly well. As we enter 2022, again, the inventory condition, especially in our market, is even more dire. We're closer to a month of inventory. Follow this out, follow it down. We're talking about 2% a month. That implies 24% appreciation over the course of the year. Now, will we get there? I don't think so, because as prices tend to rise, right, demand tends to fall a little bit. So it's a little bit self-correcting. But if we stay in 1 month of inventory, which easily could happen, given all of the constraints around building, you tell me, it looks like we're headed for another pretty bang up year in terms of appreciation. So again, as prices rise and as mortgage rates rise, it's going to tamp down this idea of, the rates of appreciation, because inventory will start to rise. Now, bear in mind, inventory rising doesn't mean prices fall until you get to 7 to 8 months of inventory. What it really means is just prices are going to rise more slowly. So this idea of, well, I'll just wait it out, it's still moving further and further away from you. So again, I think acting now is much more valuable than waiting. I think waiting is a poor strategy, given the extreme conditions in the market right now. So another thing to remember, though, too, is how a market might perform at $1 million, 500,000 and 300,000, again, are all kind of different. So price points, areas, all have different inventory inputs, meaning that you really need to get pretty hyper local. You can't expect Churchill to behave the same as Mosley, behave the same as Ashland, behave the same as Chester, right? They're all going to have their own inventory conditions and things of that nature. And so, don't just apply one blanket across the entire market. You really have to look at, all of the different inputs to compare the areas to get an idea of how these markets are likely to behave. Again, as we enter the year, we're looking at a month of inventory right now. So I'm going to finish with what would have to happen in order to make the market kind of fall, in other words, prices to turn around. Again, we talked a little bit about it. That 7 month of inventory is about where you see prices flatten. 7, maybe 6, maybe 8 months, somewhere in that range. Again, we're at 1 month right now, meaning there would almost have to be a 500 to 700% increase in the amount of inventory in order to meaningfully impact pricing. Interest rates would have to go up substantially. Again, last time that market kind of turned around, interest rates were in the 7s. So again, we've got a long ways to run. And that's, again, if we don't even have those hybrid products come back, where if you're going to own a home for 5 years and you chose a 5/1 ARM, you might only be at a 4.5 to 5% mortgage rate over that period of time. So again, things that can minimize the impact of interest rate rising aren't here yet, but as they rise, we think they'll appear. People have to start leaving Richmond. Again, we had almost a 3 times, our normal growth rate happen. Again, sucked up our available inventory, both for sale and for rent. If people turn around and start leaving Richmond, okay, well, in theory, when, the demand leaves, supply should rise. And again, these negative things would happen. But as you can see right now, the current supply inputs, not enough affordable, can't build them fast enough, can't build them cheap enough, can't develop land fast enough, can't build close in where a lot of people want to be. And this competition now emerging from investors and investment funds, on the supply side, it's constrained and getting worse. On the demand side, positive demographics, positive migration, sort of historically so, still very low interest rates, $2.3 trillion, fills up their pockets, they're going shopping with it. Again, you got rent spiking, so rents aren't a very good option. And the employment situation is also improving. So again, everything on the demand side is very positive, and everything on the supply side is showing fixed or decreasing supply. So again, when we look out there across the horizon, what do we see that's going to lead us to a negative event? It's hard to find it right now, I got to be honest. So to reiterate, those who are waiting for the housing market correction, I think are just, again, I think they're going to be left wanting and possibly have it move further and further away from them. Hundreds of thousands of dollars potentially over the life of their ownership, are going to be made or lost in the next 6 to 12 months. So those that should, be paying attention to this, they need to act early. So anyway, that's the conclusion of the presentation today. Hope you enjoyed it. We're going to be pushing out a lot of of these slides and things in terms of social media posts and things like that. So you'll be able to kind of see some of these again and kind of dive in. If you have any questions, feel free to contact us or any agent at One South, and we're more than happy to walk you through some of these things in even more depth. Thank you very much.